I'm Charlotte McLeod with the Investing News Network, and here today with me is Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Thank you so much for joining me online today. Great to see you again.
Hey, always a pleasure, Charlotte. Thanks for having me.
Of course. So we have a lot to talk about. I think we haven't spoken for 4 or 5 months. Definitely a lot of things going on in the market, and we're going to start off with gold as usual. It hasn't really been a great month so far. We saw gold under 1,700 per ounce for a little bit, although now it's back above that the last time I checked. There's a lot of commentary out there about what's happening, but I really wanted to hear your perspective on, what is happening to gold from the technical side. So I wondered if we could just broadly look at that to start off with.
Sure. Yeah. Let's take a look at the charts here of gold. So this is the daily chart of gold. And, if we were to zoom in a little bit here to the more recent time frame, from a technical standpoint, gold is looking, it's down at a major support level. It has been beat up really hard. It was gold, silver, and miners were becoming market leaders back over here earlier this year. And then the stock market kind of fell into a bear market phase. We had broad market selling, forced liquidation, lots of people getting margin calls. And when that happens, unfortunately, it pulls precious metals and miners down with it. Even though I think we're in a perfect storm for precious metals, if the masses are forced to sell and they're scared, it really does hold and pull metals down. But if we were to look at the chart here from a kind of a technical standpoint, we can see that gold just tagged 2 days ago a very critical support level. Not only has it had a very nice measured move, a nice bear flag measured move, but it came down to a price level here that we found acted as support several times in the past. And it also acted as resistance before that. So this is a high opportunity, high probability type of bounce or play here that we could see a multi-week rally in precious metals off this low. Now it is still in a downtrend, but from a investor standpoint, buying at a support level like this is a great opportunity. And I think there's room for a continued strong bounce here. And that's the same when we take a look at gold miners. If we look at GDXJ as kind of the gauge, it has come down to a critical level as well. And it's starting to find a little bit of support. Again, the downtrend is still in play. So buying here is picking a bottom. I don't pick bottoms. I'd much rather let the market rally and start to build a bullish pattern, meaning a series of higher highs and higher lows. So we need a rally, we need a pullback, we need another rally, and we need it to break specifically more so this very significant high right over here around 42 on GDXJ. It's a long ways up from where it is, but until it breaks that, we're still in a downtrend and it could continue to flounder and be out of favor for a while. So, they've been beat up pretty hard. They are at support. I think they're going to find some support here, but they might not be in favor for a long time quite, yet.
Yeah, and one of the questions that I was going to ask you, so we're in the summer right now. Of course, this is obviously usually a slow time for the metals, although not always. What are the next 3 to 6 months looking like if you try to track that for gold?
Sure. I'm going to go to the quarterly chart because it gives us a big picture analysis of, let me go to gold here. This gives us a big picture of the overall trends of where we are for gold. Now, long story short, gold has been in a very strong rally here since 2019. It's trading this sideways kind of bullish pattern, which we've got the strong rally and now it is kind of flagging sideways. You can see this as a cup and handle pattern. And so this is the cup and the handle. These are very, very strong patterns that if they resolve to the upside. So if we see gold close above 2000 and keep going on a quarterly basis, we could see a very big run. Now, keep in mind when you're saying looking forward a few months from now, each bar is 3 months. We could easily see 4 bars play out here. That's a year from now. I know a lot of people, including myself, want to see gold break out and start this run. But here's the catch. If the US stock market and the economy continue to weaken, I think we're going to be in a bear market for stocks for potentially another 8 to 16 months easily. That's going to keep pressure down on metals. It's going to, at best, metals are going to hold up. Maybe they're going to pull back a little bit more and consolidate. And so that's like another 4 or 5 bars on this chart. So I think the big move in gold is a lot further out than people are anticipating. It sure was looking pretty promising, 3 quarters ago. It was starting to break out and started the run, but it's been rejected. It's come back down. And so it's going to take some more time. Keep in mind, this goes back to, 2000, which is where the market bottom happened. So these are big patterns that take multiple years to play out. We just came out of a multi-year base, stage 1 base, which I'll explain that shortly. We're in a stage 2 bull market, and it's consolidating right now. And it's really in a super cycle, precious metals. And actually, to touch on the super cycle side of things, if I was to just show this chart really quick, this is showing us the price of commodities compared to the SP 500. And right now, where we are, this yellow dot, this is the cheapest commodities have ever been compared to the SP 500. The last time we got anywhere close to this was just in the early 2000s, which is when gold started the new bull market phase. So we are coming full circle to another super cycle, multi-year rally in gold and precious metals. But keep in mind, these are huge cycles. It might not start for another like 12 or 18 months from now. But when it does, it's going to be, I think, what we've been waiting for like 10 years, right? So it's going to be pretty exciting, but good things don't happen always when we want them to. It could take some time to unfold.
Right. So it sounds like it's still the move that you see coming is going to happen, but we need to readjust our expectations a little bit as to when it's
Yeah,
going to come. Yeah.
for sure.
So, yeah. And so when I've been talking about gold to people, one of the factors that I keep hearing mentioned is the US dollar and its strength and how that's weighing on gold. So I wondered if we could take a quick look at what's going on with the dollar and what you can tell from the charts in terms of its movement.
Sure. If we take a look at the quarterly chart of the dollar, this is the US dollar index, and more or less it's kind of doing a lot like what gold is doing, where it has been trading in this sideways formation for a while. It had a very strong run up into this. It's been flagging sideways. And this is a very bullish sign for the US dollar. And it is breaking out. And I think we're going to see the US dollar push up to 116, 120, come back up to test these highs that we saw back in 2000. And so this rising dollar adds another downwind, a pull on gold and silver to the downside until the dollar gets up to these levels. And look at the time frame. This was 2000 when we had the last major super cycle really start for gold, precious metals. So we're not there yet. Again, this based on this pattern here, it looks like we could be 4 or 5 more bars, which is, over a year from now before we get there. But when it does happen, I think the opportunity is going to be pretty darn incredible. But again, these are big patterns, and they're going to take a while to unfold. And it's understanding that we're this far away still. A lot of people are kind of thinking that every month could be the month. I see it more like, every quarter could be the quarter, but it's probably like maybe this year, but most likely next year. So it's definitely, you have to look further out and try and sit back and just let time pass, because big patterns require time to build and form and unfold and present the opportunities.
Yeah, I think that's so correct. I know it's difficult to be patient, but it sounds like that's really what is needed right now.
Mm-hmm.
Now, yeah, and looking at the dollar, I think it's also interesting to put it into context in terms of other currencies. So I wondered if you could talk about the performance in that way and what you're seeing there, if there's anything interesting to note.
Yeah, I believe it or not, I don't really follow other currencies too much. I mean, I just like to follow the US dollar index, and that's about it. I don't really go into other currencies. Like usually the yen is a defensive play, but the yen has been selling off huge. Things just are really out of whack with everything going on in the world right now. And so I really just stick to the basics: US dollar, US stocks, and commodities. and follow those.
Okay, so keeping it simple.
Yeah.
And I know that you're really focused on technical analysis, of course, but we do have the US Federal Reserve with its meeting coming up next week. I think it's probably important to talk about that. I know that for a while it seemed pretty certain that we were going to get 75 basis points for a hike. Now it seems like some people are saying it might be a full percentage point. I wondered if you could talk about your expectations, what you're thinking we may see when we get that news next week.
Yeah. I'm not sure what to expect, to be honest. I mean, I just did a mentoring session with our subscribers, and our options trader, Brian, he follows this very closely. And so I don't follow the Fed or the interest rates or try to, predict what's going on so much. I just let them unfold and follow the technicals. But, we're really not sure which way they're going to go. I mean, they were talking about a 1 percentage point, but it seems that the new stats just of a few days ago is actually talking to only 50 basis points now. So it's going to be interesting to see where things shake out. I mean, every few days it seems to be changing where the Fed is going to do it, what people are expecting. And that's one of the reasons why I don't like to follow news or economic data, and because you don't know what it is until it happens, right? And it's always really just, you're just trying to predict a price. And I don't trade on predictions, and I just kind of follow using technical analysis. I just follow price. That's the nice thing, is we get into something trending, or when it starts trending, we get into it. When it starts to show signs of weakness or reversing, we get out of it. We don't really care what caused it, what's happening, but the charts usually move before the news becomes actually known. And so really technicals to me is the leading indicator. It's the leader, and the data actually follows afterwards. So that's how I kind of see things.
Right. So when you are looking at, for example, some of the major indexes and you're anticipating these things that are coming, what are you seeing right now that we can look at to, I don't know if giving an indication of what may happen next week is the right thing to say, but what are you seeing there in terms of how it could shake out?
Sure. So what I'm looking for and kind of hoping for going forward is the stock market to actually have. So this is the SP 500 daily chart, and we've had a little bounce here over the last couple of weeks. I'm kind of hoping we're going to see a multi-month kind of rally recovery here. And to me, this is going to be a complacency rally that is going to be followed by another leg down, like a true bear market leg to the downside. Like everybody's talking about that we're in a bear market now because the stock market's dropped 20%. To me, we still need this complacency rally, and then a break of these lows is where the bear market really starts. And I actually have a infographic, a table here that I drew of this. So more or less, the stock market moves in 4 stages. Stage 1 is usually is marked red because it's volatile, it's choppy, it's unpredictable. It's kind of dead money. You're just putting money there to chop around without any real accuracy. Stage 3 is the same. It's usually very volatile. It's all over the place. Usually it's a sector or commodity driven market. They're hot for a few months or a few weeks, and then they roll over and die. So it's a bad time to trade, which is why it's red as well. The sweet spot are these stage 2, which is a bull market phase, and a stage 4, which is a bear market. And the reason they're good is because they're trending. You get in, you catch these trends. So to answer your question, what would I like to see, or where are we headed here? If we take a look at the emotions of the market, you can see here, 2020, early 2021 was this euphoric thrill phase. Everyone piled into the markets. Now we've got the bear, that first crack to the downside. I'm looking for this complacency rally that I was just mentioning on the SPY chart. And then eventually it's going to roll over, and then all hell's going to break loose. People are going to freak out, and we're going to go into a real stage 4 bear market. That is going to put pressure on pretty much all asset classes. That's when we're going to see potentially a lot more layoffs. We're going to see a lot of things happen. It's not a comfortable time for most people. Even if you are, profiting from falling market, it is still not a good economy. It's a very kind of emotional time, but that's what I think could be happening. Unfortunately, I'm not trying to be the bearer of bad news, but I hope we're going to get this complacency rally because it'll give people an opportunity to get out, get a better position, get ready for a potential bear market phase going forward, which all of that kind of leads into the next graph here, which are these two cycles. The blue cycle is the stock market cycle, and it tells you which sectors generally perform well during those stages. Energy has been on fire. Precious metals were on fire just earlier this year. So we're kind of at this topping phase. Both of these were on fire together. Since then, the stock market has topped. We've started to roll over. Utilities, healthcare, consumer cyclicals have been holding up okay. But really, we're starting this cycle down, this bear market wave. And the stock market tops out before the economy does. The economy is the yellow cycle. It'll peak out, probably, in the next quarterly readings we get, it'll be probably the tipping point. They'll be like, we're in a recession, and everybody will finally get it. So the market tops out, and then the economy follows. And the nice thing is the stock market will bottom first, and then the economy follows afterwards. So understanding these three different layers of the stages of the market or the asset is in, stage 1, 2, 3, or 4, understanding where we are in the emotional state for the masses, what everybody's saying in the media, and the types of people trading. When everyone is trading who doesn't really know anything about it is in the market, you're in this thrill euphoric phase. You better be aware. When everybody's angry and there's depression and people are giving up and selling their positions and literally they get really angry, it's usually near a market bottom. So when you can identify all these things and pull them together, you can really navigate these markets in a very controlled manner and be on the right side of these waves.
Okay, I think that was all really helpful for everybody, because what I'm getting the feeling of is, going through your chart, we're certainly past that euphoric phase where everybody wanted to be in the market because things were going so well. Now it feels like people want to be in there, but kind of out of fear, right? Because people see inflation. They want to make sure that they're in there so that they can, at least retain some value. So I think that's really important. I wondered if there's anything else we can say about, these times of volatility and how to navigate that.
You really do have to be really diligent with your position. So today we were just talking with all of our subscribers. We were talking about trade position management because this week we got in 7 trades. We've closed out 3 trades, 2 trades already, we've taken profits on 4 of them. And this market, we have a new buy signal this week on growth stocks. Now it's very short-lived, and during a complacency rally, you get these pops and then you get these strong drops. So you have to be looking to take profits or trimming your positions that are underwater. If they start to rally here, you should be looking to take the loss, bite the bullet, and get out, because if things actually do roll over and we go into a bear market, we haven't even seen selling yet compared to what we've seen. There's going to be a lot worse things to go, and getting out now at a 10-15% haircut, or I know a lot of people are in like growth stocks that are down 50-60%. They could drop a whole lot more from where they are, believe it or not. So the key here is to, in this type of condition, very short-term trades. Your trades are only going to last a few days. You get in, if you're lucky, a couple of weeks, you get out, and don't be buying and hoping things are going to go up. You should be trimming off positions. Is as unfun as it is to sell a loser, and that kind of confirms you were wrong and that you're a loser. I mean, you have to take these losses. The only way you can make money down the road long-term is by cutting your losses. You can always reinvest or buy back at a later, hopefully at a way lower price, or you buy it back at a higher price, but when it's moving back up again, instead of holding it for potentially months or quarters or years of falling in value. So you have to take partial profits, tighten your stops. When your stop gets hit, get out and look for a fresh new setup.
Okay, and so obviously you're in the market every day. You're working with people who can be pretty agile about what they're doing. Not everybody has that ability to be watching their positions quite so closely. Some people might be looking for things that are a little bit more long-term. So I wonder if you do have that longer-term position where you can't be keeping quite such a close eye on what you're doing. Do you have any advice for people who are in that position?
I do. Let me just see here. So we've got a trading strategy that we call the consistent growth strategy. Now this chart doesn't actually show it all that well, but more or less what we're looking at here is this green line. So we have it's called the technical investor. So this is like the most passive way. It's almost buy and hold. The only difference is if we zoom in on this chart just a little bit more, this green line here, you can see how it flat lines. Well, when we get into a confirmed bear market, we just sell our SP 500. This is literally you're 100% long the stock market when we're in a bull market, and you go to cash when we're in a bear market. So as you can see, value doesn't drop, it doesn't go anywhere while the stock market collapses. And then you reinvest the money back in once we're in a confirmed bull market. So this is like something that is, one step up above the buy and hold. You get the upside potential, but you don't ride the roller coaster down. And so this is like as basic as it goes. Sometimes you can go years without any new trade. You just set it and forget it. But when things get ugly, there's a time where you just say, oh, I'm going to sell it. I'm going to move to cash, and I'm just going to go live life until this bear market's over, until I get a new signal to go long. So there are ways that you can take advantage of being very passive. Just by cutting out the losses, you can perform very well going forward with a lot smaller drawdowns. And that's really the key. A lot of people think they need to hold on to positions. They think they should be in stocks and bonds, but it's not the case. Really, there are times when cash is the best play, and who cares if there's inflation? It's not like you're going to hold it for 20 years with inflation. You just want to move to the sidelines for 3, 6, 9 months while the market collapses. It's way better to pay a bit higher food, grocery bills with inflation for a few months than it is to suffer a 30 or 40% drawdown in loss on your investment portfolio.
Okay, I thank you for explaining that, because I think it's good for people to know that there's multiple ways that you can succeed in times like this. There's many ways that you can get through it.
Yeah.
So yeah, exactly. We've been talking obviously a lot about gold and commodities sector. I wondered if there are any other areas that you are keeping an eye on right now where you see potential, because we've been talking about long-term trends.
Yeah, there isn't a whole lot. Believe it or not, there's either you're in the way we work is we're either in stocks. If they're not in favor, then we're in bonds. If bonds are not in favor, which they are not, we're in the U.S. dollar ETF, which is UUP. Which, if I was to just pull that up, this mimics the U.S. dollar, which it's been one of the strongest movers this year. So this whole year, it's just been trending up very beautifully. It's had a pullback recently. Part of this pullback in the dollar is probably part of the reason why we're also seeing gold and silver try and find a bottom. Gold's pulling back a bit. ECB came out also about rates, which is helping move gold. But really, the play this year has been the dollar and cash. And as boring as it sounds, it's pretty tough to beat going forward. And the nice thing, like if you were to compare volatility of these asset classes, so the stock market, for example, recently the stock market over a 20-day window was moving the SP 500 about 14% from the extreme high to the extreme low. Bonds were moving about 8% in that same 20-day window. And then the US dollar was moving about 4%. So each time we move down an asset class, it cuts the volatility in half. And if the US dollar isn't favorable like this, we actually will trade the UDN, which is the inverse dollar. So even if the dollar index is falling, there's an ETF that's trending up. So we can move into something still climbing in value that has low volatility. So when the rest of the market is wild and everybody is panicking, we can be riding this kind of pretty stable, slow moving, horse higher to the right on the charts while everything else is kind of collapsing. And in some cases, the dollar doesn't act as a trade at all because it still has to meet our criteria. And we'll just move to like BIL, which is an ETF for the 1 to 3 month treasury bill, the T-note. And so we just move to cash and we earn a little bit of interest. It pays dividends, and you just sit there in cash and wait for the next setup. So we really strip out all the noise. We strip out, a lot of the risk. As things get riskier, we step back to more consistent, but still strong assets that are trending up. And that's how we kind of navigate this market.
Okay, yeah, and I love that you keep it so simple, right? I'm asking all of these questions about what are you doing? It's like, no, it's really not that difficult. You can step back and make it work for you fairly easily if you know what to look for. So I think that wraps up all the things that I had to ask you today, but I wanted to see if you had any final thoughts to share with the audience, maybe let them know where they can find you if they want to learn more.
Sure. Yeah. Well, they can find me at thetechnicaltraders.com. And there I provide my ETF trading strategy. They're fairly slow moving in terms of trades. We don't trade much. Our key here is to make as much money as we can with the fewest trades possible and with the lowest drawdowns and account fluctuations. And so we do that with the strategy. I showed you the graph there. We can have a very consistent growth strategy in place, and we have auto trading available. So some people who don't want to get into trading can literally just set it up and have everything traded for them. So that's kind of, we try to make it as clean and simple as possible, and then also allow the strategy to do the trading for those who want to kind of take part of it, but without having to learn and follow the markets and do all those things.
Okay, well, that's great. Thank you so much for coming on to talk about what's going on in gold and the markets. It's always great to hear from you.
Yeah, no problem. Anytime.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Chris Vermeulen with thetechnicaltraders.com.